Good, everyone. Thank you for joining us today. The reason we all joined this webinar is that we know making sound financial decisions is more important than ever, but it could be difficult to do so with all the economic noise. It seems like every day there's a new headline, a stock market, the housing market, or some other aspect of the economy. And how can you make informed decisions when it feels like everything is changing all the time? Today, I'm excited to share that our webinar is here to provide you with essential guidance and knowledge so that your investment choices are wise ones. According to Charles Schwab, we found that the average of 401k participants think that they'll need 1.9 million to retire. The reality is that many people in the US aren't investing enough to reach that savings goal. How much can you spend a year if you save for your retirement? If you stick to the 4% rule, here, how much you can withdraw annually from different nest eggs. For example, if you look at the 1 million a year, that is how much you would need to save when you retire, and you would be pulling out 40,000 a year. I don't know if that's enough for you. Many people think that the sooner they start investing, the better. While this is partially true, it's not the only thing that matters. While it's easy to leave your money sitting stagnant in a savings account or 401k, savings accounts pay you a small amount of interest, which typically equals to 2.5% annually. If you want to end up with $1 million saved for your future and you earn just 2.5% on your money, you'll need to start saving $1,800 per year for a month for approximately 20 years of age. For those of you who are teenagers out there, it's time to start your planning. Why settle for that when there's so much more potential out there? Today's agenda will be to discuss how to take control of your financial future. We're going to be discussing tax advantage accounts with Camaplan. We partnered together with them, with William Mucker, and he will be discussing the power and possibilities of an 401k with IRA account and how to qualify with a self-directed account. A little bit about myself. I'm Marika Dzhindzhikhashvili, director at Astor Realty Capital. My focus is in multiple areas, and my corporate outreach in global as well as local originations and investors as well. A little bit about Astor. It's a 65-year real estate experience company. We invest in all major US markets. Our portfolio in real estate assets is $2.27 billion. We have 100 million capital under management, and we have over 3.6 million square feet in different stages of development projects that we've invested into a private equity firm that is institutionally backed. You can see our portfolio. We focus on major markets: New Rochelle, Brooklyn, Chicago, Tampa, Miami. We love Florida, Arizona, and Texas. Those are the strong markets. And we follow the job growth. Today I want to go into introducing a little bit about first William. And William has been recognized as a Marcus Emerging Leader for their contributions and achievements in the field of real estate. And without further ado, I'll introduce you to William, and he will take over and going into a little bit about the IRA. I do want to mention as well that throughout our Zoom, I will be taking comments and questions. So please, for those of you that do have something to bring up or have a question, just raise your hand and we can address it. William, thank
Awesome.
you.
Thank you so much for having me. I want to thank Marika and everybody at Astor for having me out today to speak in front of you about self-directed IRAs. A little bit before we get started, let me see if I can take control of these slides. But before we get started, basically what Camaplan does is we're a neutral third-party administrator of self-directed IRAs. We go around and educate people about the ability to take your money off of Wall Street, your retirement funds especially, off of Wall Street, and use them into assets that you can know and understand and control, excuse me. Before we get started, I do have a brief disclosure put together by some attorneys that I do have to get through. So Camaplan is a neutral third-party administrative IRAs. We are not attorneys, CPAs, financial advisors. If it comes to a time when you need advice in any one of those fields, we are more than happy to be a part of that dialogue with your team of professionals to ensure that the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open the account, fund that account, and facilitate the transaction into that investment. Okay. Sorry, this new technology. Trying to move forward. So the big question I get is, what is a self-directed IRA? You can go to Fidelity, TD Ameritrade, Schwab, and they'll tell you you have a self-directed IRA. But what they mean by that is you can direct your investments into anything off of this list. With a true self-directed IRA, like the ones offered at Camaplan, there is no list. You find the investment that is right for you. Make sure that you're following all the prohibited transaction rules when it comes to investing with your IRA that we will be going over in the future, and we'll help facilitate that transaction. I help people open accounts every day, and you'll be shocked at a lot of people will go, the first question on the application is, what type of account do you want to open? And people get confused because there's no option for self-directed IRA. All of our accounts are self-directed. The accounts that you open with us are traditional IRAs, Roth IRAs, etc. All the same rules apply, all the same benefits apply. This is just a little quote from one of our investors. Investing in what you know, understand, and can control versus using hope as your strategy. Rather than hoping something happens overseas and the stock market fluctuates just the right way and you earn a great profit with the stock market, you can take your knowledge, whether you be a real estate investor, an angel investor, a private lender, use your retirement funds and be able to capitalize the same way that you're capitalizing with your personal funds. So as I said, all of our accounts are self-directed. There's no quote unquote self-directed IRA. These are the accounts that you can open. There are your traditional IRAs, your SEP IRAs, simple IRAs. You have your defined benefit plans and defined contribution plans, your 401ks. These are tax deferred. Then you have your tax-free accounts, your Roth IRA, which I'm pretty partial to, and we can go over that a little bit later. You have your health savings account, which is the only account of its type where the contributions are tax deferred and the distributions are also tax-free if for a qualified medical expense. You also have your educational savings account and then your Roth portions to your 401ks.
So, Will, real quick, before we go to the next slide, I just wanted to address what would you say are the benefits of some of those, which ones usually are the one that most people use and the one that would benefit the most to individuals?
A lot of people are, great question. So a lot of people are really into the Roth IRAs because they're post-tax accounts. And we have a good visual later on in the presentation. Your contributions are taxable. However, everything you earn and all of your contributions, when you take it out as a distribution of it at an eligible age, are tax-free. We'd also have a lot of people that do the traditional IRAs to lower their tax liability, but Roth, we're very partial to the Roth IRAs at Camaplan, and we do see a lot of people.
When would be the best time for someone to start with that? How would someone begin with the Roth IRA?
So depending on your financial background, always talk it over with your tax professional. If you have a traditional IRA, you can move it over and do a Roth conversion. There are some restrictions with the Roth IRAs based off your income. So you'll also want to talk that over with your tax professional, but there are ways around it, like the backdoor Roth contribution. But we recommend, the younger, the better. I have 2 nieces and 2 nephews, and they're, only a couple of years old, And I opened them Roth IRAs as soon as they were born so that they can start earning that benefit from the time from a young age, and they'll have that benefit through college and when they eventually just retire years down the line.
Okay.
You can go to the next slide. So here are the differences between the 401k and the IRAs. A lot of people ask me, can I open a solo 401k? And what I tell them, sorry, 1 minute, my computer's acting up.
I do have a quick question from somebody from our audience, Latanya Adam. We're happy to answer Latanya's question.
Yes, Latanya.
Guys, this is Laura here. Let me just, I'm going to allow Latanya to talk.
Thank you, Laura.
Hi, Latanya.
Latanya, you can just unmute yourself and we'll address your question.
Okay. Hello, how you guys doing?
Hi, Latanya.
Hi. Are you guys still with Equity Trust? Or if everybody, if someone already lost some of their money in 401k, how do that person start over to start fresh? I still got some money in the 401k, but if somebody is like starting over, what would be the advice for them?
So if you're starting over with your 401k, if you took a loss like a lot of people have, the best thing you can do, and again, I'm not a tax professional or financial advisor, is to put your money in what you understand. There have been a lot of fluctuations in the stock markets lately. So if you're a real estate investor, you can put it into real estate, you can lend money. You can also be an angel investor and invest into privately traded companies. So whatever you're more comfortable with and what you can earn the best return with is probably the best plan of action.
And if a person do get with you guys, are you guys still with Equity Trust, or did you guys go with another company? Because they are terrible. They are.
When
Because
you
they
say,
was
not to interrupt, when you say you guys, are you talking about us as Camaplan or
no,
Astor?
no, the Astor, is Astor still with like, how do I say?
Hi, Latanya. This is Lauren.
Yes.
Hi. To answer your
Hi.
question, we have many partners who we, just like Camaplan, who we do partner with and make recommendations for our investors to use. So Equity Trust is another company, but today this is Camaplan who we are speaking with. So all investors have a choice as to who they decide to proceed forward with as their IRA custodian.
Well, that is cool. That is very nice to have the option for everybody. So I like that better. Because I had that experience with Equity Trust. So oh yeah, so that's good to know. So I'm happy to hear that. Yes. What thing?
Thank you, Latanya, and thank you, Laura, for jumping in with that.
Thank you, Latanya. So this graph here is a good visual. We have 4 different avenues of investment, and how much, if you earn $100,000 in 4 different avenues of investment, what do you get to keep? You have your W-2 income. If you invest that and you earn $100,000 back, you're paying roughly, in this example, 40% in taxes, and you're only walking away with $60,000. Then you have your passive income. You make $100,000 back. With that, you're only paying a little bit less with 25% taxes. You're walking away with $75,000. The great thing is with tax deferred and your tax-free accounts, both of them you earn $100,000 because they're in a tax sheltered environment. Now there's an asterisk next to the tax deferred like your traditional IRAs, because you're going to be taxed on that when you take it out at the end. The tax-free, your Roths, HSAs, and ESAs, that's $100,000 in cash tax-free when you take it out. So that's one reason why I'm partial to the Roth IRAs.
So another question I have. one of them would be, are there any limitations to the investments I can make based on the account that I used?
Great question. So whether it be a traditional IRA or Roth IRA, a solo 401k, there's no difference in the types of investments you can make. They're all treated like trusts by the IRS, roughly similar to trusts. The IRA is the investor, a separate entity from yourself, separate entity from Camaplan, separate entity from any LLCs you have, and they can all make the same investments. There's no limitations.
Okay. And what would you say is the easiest account to invest in?
I would say a lot gets involved with the employer link plans. There are definitely benefits to them. So the SEP IRAs and simple IRAs, especially the solo 401ks, there's a lot more you have to look after. Especially with Camaplan, if you open a solo 401k with us, we don't do reporting for 401ks. We'll only do reporting for IRAs. I find the simplest accounts to invest with are the traditional and the Roth IRAs. We provide you all the tax documents, and it's I would say that's the most simple account to invest through. But whatever benefits you best, whatever your tax professional or your financial advisor advises you on, we'll go by that.
Okay.
This is a little bit more information about the previous slide. So this is a chart. This is over 40 years at I believe a 10% rate of return. You and 3 friends decide to invest $50,000. Blue is your taxable, light green is your tax deferred, and your dark green is your tax free. Now, your friend who invested their W-2 funds, the taxable funds, over 40 years at a 10% rate of return, earned $700,000. Your other friend with the light green, your tax deferred, your traditional IRA. Actually, it's important to note that the traditional IRA, the tax deferred, and the tax-free accounts both earned $2.2 million over that for 40 years. However, the tax deferred account had to pay taxes when it took it out. So they had to pay $700,000 in taxes, where the tax-free account, that $2.2 million is tax-free at distribution and in their pocket.
A quick question in there.
Yes.
What would a person need, or can someone open a solo account, and what would the eligibility be on that?
So when you're opening a solo 401k, it has to be a business that you have earned income from to be able to contribute to a solo 401k. And it also has to be, you also cannot have any employees, because when you have employees, what's required is ERISA testing, which makes sure you're being fair amongst all the employees that are a part of the plan. We don't offer that ERISA testing. So no employees, and you have to have earned income from that business.
Okay.
Great question. Thank you. Another question people ask a lot is, what types of investments can I make with a self-directed IRA? So these are some of the things. You're not limited to them. I've seen a lot of crazy things. The biggest things are real estate, notes and mortgages, private lending, private placements, privately traded companies, precious metals. And then we have we have people that invest into cryptocurrencies. And like I said, I've seen some crazy things. People have bought sheep and sold the wool. People have bought bees and sold the honey, bought fruit trees and sold the fruit. Whatever your imagination can come to, as long as you're following the prohibited transactions guidelines, there's a lot of leeway.
Can we go over a little bit, just high level in the steps of, for example, let's say real estate investing? That's something that probably some of our audience and myself can relate to. What would the steps be? So, okay, so I joined, I created an account. Can you just walk us through those steps up to the point where, okay, I'm ready to invest in a project in real estate? What would the steps be through that?
Yeah, absolutely. So the way it works is the first step would be obviously opening the account. You'll determine that based off the account you plan on funding it with. So if you have you have a 401k that's tax deferred, or if you have a tax-free account, you'll want to move it over to a like type account. So tax deferred to tax deferred, or Roth to Roth. You'll open the account. If you're coming from a 401k, you'll initiate a rollover. It's coming from another IRA. It'll be an IRA to IRA transfer, which is not taxable, nor is it reportable. we actually request those transfers on the client's behalf. Then once the account's been funded, we tell people to expect on average about 2 weeks for the account to get funded, but there are a number of factors that go into it. But when you start getting to the actual investment portion, the first thing you should know is the IRA. I've said this before, the IRA is a separate entity from yourself. So what you'll do is you'll find the property that's right for you in the example of real estate. You'll get an agreement of sale where the IRA is the purchaser, not you personally. So for that purpose, the entity is titled like this. It's going to be something along the lines of this: Camaplan, FBO, which stands for benefit of, your name, IRA. And that's for a traditional IRA. If you had a Roth IRA, you'd end it with a Roth IRA. Now you'll get that agreement of sale. You'll initial next to the signature line for the IRA. That lets us know at Camaplan that you've read and approved of the agreement. Then you'll send that into Camaplan with our asset purchase directive. That's our direction of investment form. Just tells us what you're investing in. Is there a down payment? How much you're sending, where we're sending it, and how you'd like it sent. Once we have that, we'll look it over, process it within 2 business days, assuming everything's in good order. Then we'll sign on behalf of the IRA as third-party administrator, and based off your instructions, send the money to the title company.
And are there any limitations or anything specific that people would need to know that come up during those transitions?
During the transactions, we'll go over this a little bit later. There are prohibited transactions, but the biggest thing is usually the biggest obstacle is getting the account funded, because we're working with a number of different investment providers, or should I say, we're working with a number of different custodians, number of different processing timelines, number of different requirements. So the best thing you can do is to reach out to your custodian or plan administrator to find out their requirements and make sure that you completely understand what they need to initiate that rollover or transfer. And then once you understand that, the rest of the process is we pretty much hold the hand of that investor through that transaction. We just can't give any advice, but we can tell you how we've seen it done and how it has to be done.
Okay, thank you. And I also want to just open up some space, to our audience while you go over to the next slide, just in case anyone had any specific questions in regards to what we were just discussing. Please raise your hand and we'll address them so we can move on.
Perfect. So while people are getting their questions ready, one of those options that we mentioned, and we've touched on this, is real estate. Now, you're not limited to single family. It could be multifamily. You could buy apartments, condominiums. It could be commercial property. It could be undeveloped land. The transactions all work similar. The biggest thing you need to grasp is the IRA is the one doing the investment. It's a completely separate entity from you. And then the IRA doesn't have to own the property 100%. It could be 50%, and you can partner with different entities. You can partner with your personal funds. You can partner with an LLC, another retirement account. But whatever that percentage of ownership the IRA has is the percentage of all expenses it's responsible for paying, as well as all return it's entitled to.
Okay.
Perfect. Next slide, please. Or if I can do it. Having some trouble, so I apologize.
No problem, Will. I took over here, but I'm more than happy to do it.
Very much appreciated. I've noticed. Thank you. So next we have private placements. This is when you invest into privately traded companies that aren't listed in the stock market. Transaction works very similar. Most likely they'll have something along the lines of a subscription agreement. On that subscription agreement, just like on that agreement of sale, the subscriber is not you, it's the IRA. That's the same vesting that I gave before. You'll initial next to the signature line for the IRA and send that into Camaplan with the asset purchase directive. 2 business days, assuming it's in good order, we'll sign it and send it over. So again, these are companies that aren't currently listed on the stock market. Your smaller businesses, hedge funds, investment clubs, LLCs, LPs, all of that good stuff.
Quick question. What,
Yes.
for example, I know you said for the younger generation or for your nieces, you're the one who started for them. But for example, if, what is the age that you can start on your own to go and start preparing with your IRA plans and preparing for your retirement? What age do typically do you recommend, or when is it best to start? And when that does happen, what is the amount that someone can start with?
Great question. So the younger, the better. As soon as you have earned income, you're eligible to start contributing to an IRA. So that's why I said when my nieces and nephews were born, I opened them Roth IRAs right away. Now, depending on what your tax professional and your financial advisor advises you on, the way I've seen people do this in the past is they'll invoice them for picking up their toys. Some people have businesses and they'll take photos of their children and wrap their cars in them and pay their children a modeling fee. And then they'll put those funds into a Roth IRA, for example, and then use that to grow in the future. Now, the limitations on the contributions are based off of the account. Now, traditional and Roth IRAs are $6,500, $7,500 if you're over 50, because there's a $1,000 catch-up limit. SEP IRAs and the other employer plans have higher contribution limits because they're attached to an employer.
Okay, thank you.
Absolutely. Thanks for the question. Next slide we have is prohibited transactions. And this does not just apply to self-directed IRAs. This is any IRA anywhere. So the big things are no self-dealing, no personal use. So for the example of if you use your IRA or 401k to invest into real estate, you as the account holder and a number of disqualified persons to you, and we'll go over that in a future slide, are disqualified from receiving a direct benefit from the IRA or its investments, as well as providing a direct benefit to the IRA and its investments. So when it comes to real estate, you as the account holder and these disqualified persons cannot live in the property, not even one day out of the year, even if the IRA just owns 1%. As soon as the IRA gets involved, you have to follow them to the full extent. You cannot live in the property. You cannot work on the property. There's no sweat equity. You can pick the color of the paint. You can pick the contractors, but you can't go in there with a paintbrush or a hammer and nails. A lot of people ask me, with these prohibited transactions, how do they get caught? It's not like the IRS is following you around with drones, at least not yet. So from what I've heard about from attorneys is you'll have a significant other or a family member, neighbor that knows you're doing these prohibited transactions. You have a falling out, and then they'll report you to the IRS, and then that blows up your entire IRA. Stay away from it. It's not even worth it. You can do it without these prohibited transactions and still make a killing.
Okay, just a question. Can you walk us through how someone can invest in an asset through a self-directed account?
How they can invest into an asset through the self-directed IRA? So yeah, absolutely. So it all depends on the asset class, what type of investment it is. We went over real estate. We went over private placements. You open the account, you get the account funded, and then you submit the necessary purchase paperwork. With the subscription, with the private placements, it's a subscription agreement and the supporting paperwork. If it's real estate, it's an agreement of sale. If it's lending, you have the promissory note and any security paperwork. If it's precious metals, you'll have an invoice from that precious metal supplier that you're working with. But whatever it is, we'll help walk you through that process and get that transaction process within 2 business days of receiving that paperwork in good order.
Okay.
Thank you. So these are the disqualified persons that I mentioned earlier. Anybody in blue are prohibited, including yourself as the account holder. Anybody in green is not prohibited. So it's mainly anybody of lineal ascent or descent of you, as well as any entity that these people own 50% or more of. Now even though they're prohibited from receiving your direct benefit or providing a direct benefit, you can still partner with these entities as long as you're still following those prohibited transaction rules where they're not receiving the direct benefit or providing direct benefit to that investment. I think the reasoning behind this is the IRS wants to I'm blanking on the word, prevent against, not estate taxes. I'm sorry, I'm blanking. I know what's wrong with me today. I guess I didn't get enough sleep. but yeah,
So
go ahead.
let me
Sorry.
address a question in here while you're thinking about. So what happens if you mistakenly make prohibited transactions? What happens with that? How do you get fined? How does someone address that?
Another great question. So if you find yourself in a sticky situation where you realize that you've done a prohibited transaction, as soon as you realize that, you should do your best to rectify it. For example, if you paid for an expense personally that the IRA was supposed to pay for, that's a no-go. Now, if we found out that you did that, you can have you'll just rectify that mistake. You'll have a non-disqualified person pay for that expense, and the IRA can reimburse them or have that expense paid directly out of the IRA. What was I gonna say? As long as you're not, intentionally doing it, the IRS, I believe, gives people some leeway. But if you're doing a prohibited transaction, what happens is they'll go back to as far back as they can figure out that you 100% were doing this prohibited transaction, and then mark everything from that point forward as a distribution and force you to pay the taxes, and then the IRA is not usable anymore. So the punishment is pretty strict. So that's why we tell people, avoid it where you can.
Okay.
All right. How does the process work? So we went over this a little bit to just at a very high level. You find the account that's right for you by figuring out what account you plan on funding it from. Open the account, takes about 15 minutes. Then the funding process, as I said, is usually the biggest obstacle. It's not too bad, but once you get it under control, if it's 401k, you're doing a rollover. If it's 401k to an IRA, you're doing a rollover. If it's an IRA to another IRA, that's a transfer. Again, expect on average about 2 weeks for that to take place because we're accounting on other custodians' processing timelines. If the funds in that account are liquidated or not, if they're sending a check or a wire, postal service times. There are a number of factors that go into it. I've seen people get funded as quickly as the very next day. I've also seen people wait 2 or 3 weeks, depending. Next step. Go ahead. Sorry.
Just real quick, while we're talking about the funding, so
Yes.
can you touch on some of the qualifications, maybe that for some people that are not sure if they qualify for an IRA, can we discuss some of that? Like, what does it take for me to be qualified for an IRA? How do I begin?
Absolutely. So if you don't have an IRA yet or a retirement plan yet, as long as you've earned income, you'll qualify to open a traditional IRA. Roth IRA has some income limitations based off of how much you earn. But if you can't make Roth contributions, you can still get money into Roth via backdoor Roth contribution. Now, whether you're eligible to move that money from another retirement plan depends on a few things. For example, 401ks have some restrictions based off of if you're an active employee or not. If you're not active anymore, you can definitely roll it over into an IRA or another retirement plan of like type. And then if you're actively employed, it depends on the plan itself. Every plan is a little bit different. Every plan document is a little bit different. What you're actually looking for is if the plan allows for what's called an in-service rollover, which means you're still actively employed, but you're taking some money or all of the money out and moving it over into another retirement plan. They'll give you one of 3 answers. If you ask them this, they'll say, yes, you can roll over all of it. Yes, but you can only roll over a portion of it, or no, you can't roll over anything. And then the other thing you can look for is that if you're an active employer with a 401k, active employee with a 401k, is if that plan allows for what's called an outsourced plan, which means you're basically opening up a sub account of that 401k and then moving it over specifically for alternative investments. It's still a part of the actual plan. All funds will return to that main plan. All reporting is done by that main plan, but it's a way to get around and actually use those funds for alternative investments.
Thank you.
Absolutely. Now, what does Camaplan do? Why do you need us? So the IRS requires you to have a neutral third-party administrator to keep record of those transactions and report to the IRS at the end of every year. That's what we do. So we keep records of the transactions. We do the reporting. We help facilitate the transaction. And we're a part of your core team of professionals. Like I said, if you have financial advisors, attorneys, tax professionals that you're working with, bring them into a phone call, bring them into the office. We'll be a part of that conversation and make sure it's structured the way that best suits you and your team's plans. Tax considerations. This is what a lot of people don't know when it comes to investing with an IRA anywhere. Usually IRAs don't pay taxes. They're in a tax sheltered environment, but in some instances they actually do. These instances are UBTI and UDFI. UBTI is unrelated business taxable income. It's also referred to as UBIT, unrelated business income tax. And you also have UDFI, or unrelated debt financed income. People that end up paying this tax tend to be okay with it because you're paying taxes outside of the account anyway. And depending on the deal, you're still using it to grow your retirement plan much quicker than you were on the stock market. Here's some information. If you have trouble sleeping at night, feel free to leave these by the bedside. This is just to prove to you that everything in this presentation is not taken out of context. This is all IRS. These are all IRS publications and forms that back up everything presented in this webinar.
A question about how much do I have to pay if my IRA has UDFI or UBIT?
Great question. Now that depends on the transaction itself. I don't know exactly how much you'll end up paying. I'm not a tax professional. So how the process works is, if you're doing something that triggers UBIT or UDFI, which I'll go over those things in just a second, what you'll do is you'll work with your tax professional, and then they'll file the form 990T. That's the tax form that's filed when the IRA has to pay taxes. They'll send that into Camaplan. We'll sign on behalf of the IRA and send the money for the taxes from the IRA. Now, the things that trigger these taxes for UBTI, this is when, for UBTI specifically, is when the IRS thinks you're running a business out of the IRA or retirement plan. So the big things that trigger this are flipping properties. The IRS will see it as inventory in and inventory in, those properties that you're flipping. What the IRS defines as a flip, they'll never say. Some people will say you can do one flip a year. Some people say if you hold a property for a certain amount of time, you're fine, but those people are not the IRS. Another thing that triggers the UBTI tax is developing on undeveloped land. That's something that'll also trigger UBTI. Now, when it comes to UDFI, that's when you actually are getting financing for an investment made out of the IRA. So if you have a property that you're looking into and you don't have all the funds available in your IRA, it is possible to get a mortgage for that property, but it has to be through what's called a non-recourse loan. If you're not familiar with that, basically what that is a loan that's made to the IRA, and because it's made to the IRA, you as the account holder cannot personally guarantee that loan. So usually the requirements are a little bit higher. And then also, if the IRA were to default on a payment for that loan, the only recourse the lender has is usually they'll just go after the property that's secured with that loan. They can't go to another IRA. They can't go to any of your other retirement plans, and they can't go through that retirement plan into your personal holdings. Again, another reason why the requirements for these loans are a little bit more than your traditional loans.
Okay, so I have a couple of questions that was dropped by our audience, so I just want to address some of that. One of the questions is, what is the most common account that people use for real estate investing?
Most common account that people use for real estate investing, I would have to say traditional and Roths are definitely the most prominent. Probably traditional, because most people, when they actually start using traditional IRAs, do it a little bit too late because the education out there isn't great on these retirement plans. So it's more beneficial at that point to start having the tax benefits of the deferred taxes. But the next biggest one is definitely the Roth for people that worked with their tax professional to move those funds over into a Roth or got started early enough where they were able to use those benefits.
Okay. And another question, can I partner different accounts into a single investment opportunity?
Yes, absolutely. So I went over this a little bit in the disqualified or prohibited transaction slide. So the IRA can partner with other entities, even if they're disqualified persons, as long as it's strictly for investment purposes. So the IRA can split an investment 50-50 with another entity, 70-30, whatever percentage it is that works best for them. However, whatever percentage the IRA owns is the percentage of all expenses that the IRA has to pay. And, in the example of real estate, these expenses include down payment, purchase price, renovations, utility bills, anything like that. That percentage of ownership is the percentage of that expense that the IRA has to pay. And that percentage of ownership is also the percentage of return that the IRA is entitled to. And when it comes to real estate, that's, the rental income and the eventual sale of the property, that percentage goes back to the IRA.
Got it. I have a question also from Liel. She's asking, are IRAs the same as private investments?
Good questions. And the IRA is actually the account itself. It stands for individual retirement account or individual retirement annuity, depending on where you open it. So the IRA is a specific type of entity. I wouldn't consider it a private investment.
Okay, thank you. And in your experience with many investment types, why do your investors mainly invest in real estate, if so?
I think the big reason for that is real estate is probably the biggest asset class for alternative investors out there. And a lot of, events we go to are real estate events. And people like the fact that these investments are tangible. You can go down to 123 Main Street. You can see it, you can touch it, you can kick it, it's there. And you have a better ability to control your income from that property. Rather than, the stock market or something that you may not be very familiar with.
And the question from Khalid, when it comes to holding real estate under a self-directed IRA, are there any cons?
I would say the cons when investing with a self-directed IRA, specifically for real estate, Khalid, is the prohibited transactions. It's not a huge downfall because, we make it pretty easy for you to be able to keep it arm's length transaction, but you have to be very familiar with those transactions. You don't want to go in there, like I said, and put any sweat equity into that building. And you don't want to accidentally, rent it out to one of those prohibited people. Those are probably the biggest downfalls. And then you don't have checkbook control standard from the beginning with self-directed IRA. There are ways to get checkbook control, but you do have to submit the transaction through Camaplan or your custodian and wait for that to take place. But there are ways to make that simpler.
So here's a very big question that, I'm sure a lot of people want to know is mainly, this big question about the taxes. How do I save on the taxes? How do I defer the taxes? Could we touch on that? And when you do touch on that, also, what are some of the tips that you can give to our audience?
Great question. So without getting too far into tax advice, because again, I'm not a tax professional.
Mhm.
Great way to save on taxes is, if your tax liability is high, in my opinion, is to open a tax deferred IRA, make contributions, whatever account you can make the highest contribution that you're eligible for. So if you can do something like a SEP IRA or simple IRA, if you're a small business owner, those contribution limits are much higher. That'll lower your tax liability for the year. That's pretty much the main way to, these IRAs come with the tax benefits, because when you actually get the funds into the IRA, it's in a tax sheltered account. So it doesn't, and when it's within the IRA, again, it doesn't pay any taxes except for those two instances that I mentioned earlier with UBIT and UDFI.
And another good question, for example, when we do put money in real estate, what happens when there's a capital call? How does that get addressed?
Great question. So when there's a capital call, just from the perspective of Camaplan, how the actual transaction will work is you'll receive that capital call notice from your investment provider. What you'll do is you have an online portal with Camaplan. It shows all your investments. There's a section in there for payment or request payments. You'll go to that section. You'll mark it as an additional funding for an existing investment, select the investment and how you want us to send it to the investment provider. Then all we need with that is for you to upload a call that upload a copy of that capital call, and we process we would process that again within 2 business days. A lot of times those are actually processed within 1 business day from being submitted on the online portal.
Okay, and another thing, let's touch on a couple of tips on, when do you withdraw your balance from your IRA? What are the tips on that, and how long do you keep it? And can we also touch on, putting the max amount into your IRA? How does that work? And what are your tips on that?
How to put the max amount into the IRA?
Yeah.
So, with that, you just need to, figure out what your contribution limit is for the account. So, like I said earlier, traditional and Roth IRAs, the maximum contribution limit is $6,500, or if you're over 50, you have an extra $1,000 you can put into it, which makes it $7,500. SEP IRAs and simple IRAs and solo 401ks, there's employer plans where the employer can match and their salary deferrals. Those contribution limits are much higher, but it's actually dependent on what you earn from that business. So this would be a better question for a tax professional. I wish I could answer that better, but yeah, figure out what the contribution limit is specifically for that account to get those funds in there.
Okay. And also, just what would be some of the most important questions when someone is interviewing an IRA firm? What are some of the most important things that they need to address when choosing a firm?
Great question. So you want to make sure that the firm matches up to how you would expect the transaction to go. So you want to know their fee schedule, their processing timelines. You want to understand their customer service. So if you call in and you can get somebody on the line as soon as you call in, that's a good sign of good customer service, because a lot of times with these transactions, specifically the more or the less passive investments like real estate, where you may have to be watching the tenants, you're collecting income, you have utility bills and expenses to pay. You want to be sure that the investment or the custodian that you're working with is reachable. You don't want to be on hold for over an hour to be able to get somebody on the line to ask a question that might take 10 minutes to answer.
Okay. Very well. So we've reached our timeline. I wanted to know if there's anything specific that you want to make sure that we touch on before we end our call. We don't have any more questions.
No, I think we covered a lot at a high level. If you have any more questions that you couldn't think of while we're on the presentation today, when it applies to self-direction or your specific situation, here's my contact information. You can reach me at wmucker@camaplan.com. That's my first initial and last name, or 866-559-4430. Just ask for Will and they'll send you right over.
Very well. Thank you, Will. So thank you all for joining us. And if you do have any specific questions or you want to learn more about Astor as well, if you haven't joined us so far, we're here to answer your questions. And I just want to let everybody know also that we will be hosting more webinars that are like this to address all areas, whether it's IRAs or taxes or anything that has to do with real estate. We're definitely familiar with that. So thank you, Will, for joining us, and thank you, everyone. And I'll see you again soon.
Thank you, Marika, and thank you, Astor, and thank you, everybody. I appreciate your time.